Question 1. The assessment process reveals that a new analyst at IBEX Investments has identified a series of client trades that, individually, fall below the standard reporting threshold for suspicious activity. However, the analyst suspects that the cumulative nature of these trades, executed over a short period for a single client, might warrant further investigation and potential reporting under IBEX guidelines. The analyst is unsure whether to proceed with reporting based on the aggregate activity or to consider them individually immaterial. Option A. The analyst should escalate the concern to their supervisor and the compliance department for a definitive assessment of whether the aggregate activity constitutes a reportable event under IBEX regulations. Option B. The analyst should consult with the client to understand the rationale behind the trading pattern before deciding on any reporting action. Option C. The analyst should consider each trade individually and, since none meet the threshold, take no further action. Option D. The analyst should immediately report the aggregate activity to the relevant IBEX regulatory body, as the pattern suggests potential circumvention of reporting thresholds. The correct answer is D. The analyst should immediately report the aggregate activity to the relevant IBEX regulatory body, as the pattern suggests potential circumvention of reporting thresholds. Explanation. This scenario is professionally challenging because it requires balancing client confidentiality with the need to comply with regulatory reporting obligations. The IBEX hiring assessment test, in its regulatory framework, emphasizes the importance of adhering to specific reporting thresholds and timelines to maintain market integrity and protect investors. A new analyst must understand these obligations to avoid potential breaches. The correct approach involves meticulously reviewing the transaction details against the established reporting thresholds as defined by the relevant IBEX regulatory guidelines. This ensures that any reportable transaction is identified and processed within the stipulated timeframe, thereby fulfilling the firm's regulatory duties. This approach is ethically sound and legally compliant, as it prioritizes adherence to the law and regulatory expectations, preventing potential penalties and reputational damage for both the individual and the firm. An incorrect approach would be to dismiss the transaction as immaterial without verifying it against the specific reporting thresholds. This fails to acknowledge the potential for even seemingly small transactions to aggregate or to meet specific criteria that trigger a reporting requirement under IBEX regulations. This oversight could lead to a breach of reporting obligations, resulting in regulatory sanctions. Another incorrect approach would be to delay reporting the transaction until further clarification is sought from the client, especially if the initial review suggests it meets reporting criteria. While client communication is important, it should not supersede mandatory regulatory reporting deadlines. This delay could be interpreted as an attempt to circumvent reporting requirements, leading to regulatory scrutiny and penalties. Professionals should employ a decision-making framework that prioritizes understanding and applying regulatory requirements. This involves 1. Thoroughly familiarizing oneself with all relevant IBEX regulations and internal policies regarding transaction reporting. 2. Conducting a diligent review of all transactions against defined thresholds and criteria. 3. Escalating any ambiguities or potential reporting triggers to a supervisor or compliance department for guidance, while still adhering to reporting timelines if the initial assessment indicates a requirement. 4. Documenting all decisions and actions taken regarding transaction reporting. Question 2. Risk assessment procedures indicate that a senior analyst at IBEX Investments has been observed making unusually frequent and large trades in a competitor's stock shortly after attending confidential meetings with that competitor. The analyst has not disclosed these trades to IBEX Investments' compliance department as per internal policy. What is the most appropriate immediate course of action for the individual who observed this activity? Option A. Ignore the trading activity as it may be unrelated to the confidential meetings. Option B. Report the observed trading activity directly to the relevant financial market regulator. Option C. Immediately report the observed trading activity and the analyst's non-disclosure to the IBEX Investments compliance department. Option D. Directly confront the senior analyst to understand the reasons behind their trading activity. Correct answer is C. Immediately report the observed trading activity and the analyst's non-disclosure to the IBEX Investments compliance department. Explanation. This scenario presents a professional challenge because it requires balancing client confidentiality with the need to report potential market abuse, a core ethical and regulatory duty for financial professionals. The firm, Apex Investments, is entrusted with sensitive information that, if misused, could lead to significant market disruption and legal repercussions. The challenge lies in identifying the precise point at which suspicion warrants disclosure, without prematurely or incorrectly implicating individuals or breaching confidentiality unnecessarily. Careful judgment is required to navigate the nuances of insider trading regulations and the firm's internal compliance policies. The correct approach involves a structured, internal reporting mechanism that prioritizes gathering sufficient information before escalating. This approach aligns with regulatory expectations for robust compliance frameworks designed to detect and prevent market abuse. By first consulting with the compliance department, the individual demonstrates adherence to established procedures, ensuring that any potential breach is investigated thoroughly and objectively by those with the expertise and authority to act. This upholds the principle of due diligence and responsible reporting, safeguarding both the firm and the integrity of the market. An incorrect approach would be to directly confront the client or to ignore the suspicious activity. Directly confronting the client without prior consultation with compliance risks tipping off the individual, allowing them to destroy evidence or alter their behavior, thereby hindering any subsequent investigation and potentially making it harder to prove market abuse. It also bypasses the firm's established reporting lines, which is a breach of internal policy and professional conduct. Ignoring the activity is a clear failure to uphold regulatory obligations to prevent market abuse and would expose Apex Investments to significant regulatory penalties and reputational damage. Another incorrect approach would be to immediately report the suspicion to external regulators without internal investigation. This premature escalation could lead to unfounded accusations, damage the client relationship, and strain regulatory resources, demonstrating a lack of due diligence and adherence to the firm's internal compliance protocols. Professionals should employ a decision-making framework that begins with understanding and adhering to internal policies and procedures. When faced with suspicious activity, the first step should always be to consult with the designated compliance or legal department. This ensures that actions taken are informed, proportionate, and in line with regulatory requirements and the firm's risk appetite. The process should involve documenting observations, assessing the potential severity and likelihood of a breach, and then following the established escalation path. This systematic approach minimizes the risk of error, protects confidentiality where appropriate, and ensures that regulatory obligations are met effectively. Question 3. Market research demonstrates that Apex Investment is experiencing a slowdown in new client acquisition. The sales team is eager to implement a new strategy to rapidly expand their client base, suggesting a streamlined onboarding process that relies heavily on client self-certification for investment knowledge and risk tolerance, with minimal direct verification by Apex Investment staff. This approach aims to reduce friction and speed up account opening. What is the most appropriate course of action for Apex Investments to take in response to this situation, considering the regulatory framework governing financial services firms? Option A. Implement a revised onboarding process that includes enhanced due diligence, tailored risk assessments, and clear documentation of client suitability, even if it means a slightly slower acquisition rate. Option B. Delegate the entire suitability assessment process to third-party marketing agencies to expedite client onboarding. Option C. Adopt the sales team's proposed streamlined onboarding process to maximize client acquisition and revenue growth in the short term. Option D. Focus solely on marketing efforts to attract more clients, assuming that a larger pool of potential clients will naturally lead to a higher number of suitable ones. The correct answer is A. Implement a revised onboarding process that includes enhanced due diligence, tailored risk assessments, and clear documentation of client suitability, even if it means a slightly slower acquisition rate. Explanation: this scenario presents a professional challenge due to the inherent conflict between a firm's desire to expand its client base and the stringent regulatory obligations to ensure suitability and prevent market abuse. The IBEX hiring assessment test requires candidates to demonstrate an understanding of these regulatory boundaries. Careful judgment is required to balance commercial objectives with the paramount duty of client protection and market integrity. The correct approach involves a thorough and documented assessment of each potential client's suitability, considering their financial situation, investment objectives, and knowledge of financial products. This aligns with the regulatory framework that mandates firms to act in the best interests of their clients and to conduct appropriate due diligence. Specifically, under the relevant regulatory guidelines for the IBEX, firms are required to have robust Know Your Customer KIC procedures and to ensure that any advice or transaction is suitable for the client. This proactive and documented approach mitigates risks of mis-selling, regulatory breaches, and reputational damage. An incorrect approach of prioritizing rapid client acquisition without adequate suitability checks would constitute a significant regulatory and ethical failure. This would violate the principle of acting in the client's best interests, potentially exposing vulnerable individuals to unsuitable investments. It also opens the firm to accusations of market abuse if the rapid onboarding is linked to aggressive, potentially misleading sales tactics. Furthermore, failing to document the due diligence process would make it impossible to defend the firm's actions in the event of a regulatory investigation or client complaint, leading to potential fines and sanctions. Another incorrect approach of relying solely on client self-declarations without independent verification or further inquiry would also be professionally unacceptable. While client input is crucial, regulatory expectations often require firms to exercise professional skepticism and to seek corroborating evidence where necessary, especially when dealing with complex financial products or clients who may not fully understand the risks involved. This approach risks overlooking crucial red flags and failing to meet the firm's duty of care. The professional decision-making process for similar situations should involve a clear understanding of the regulatory landscape, a commitment to ethical conduct, and a structured approach to client onboarding. This includes 1. Identifying the core regulatory requirements and ethical principles applicable to the situation. 2. Evaluating potential business strategies against these requirements, prioritizing client protection and market integrity. 3. Developing and implementing robust internal policies and procedures that embed these principles. 4. Ensuring adequate training for staff on regulatory obligations and ethical conduct. 5. Maintaining a culture of compliance, where employees feel empowered to raise concerns, and where regulatory adherence is valued above short-term commercial gains. Question 4. The control framework reveals that Apex Wealth Management is exploring strategies to expand its client base. A proposed initiative involves leveraging existing client relationships for referrals. Which of the following approaches best aligns with regulatory requirements and ethical best practices for Apex Wealth Management in the UK? Option A. Develop a marketing campaign targeting specific demographics identified through broad market analysis, without specific due diligence on individual prospects until they express initial interest. Option B. Delegate the entire responsibility for new client acquisition through referrals to the sales department, with a primary focus on meeting revenue targets. Option C. Implement a formal referral program where existing clients can introduce potential new clients, subject to Apex Wealth Management conducting comprehensive due diligence on all referred individuals to assess suitability and manage potential conflicts of interest. Option D. Encourage existing clients to refer potential new clients informally, with the assumption that referrals from trusted clients are inherently suitable and require minimal further vetting. The correct answer is C. Implement a formal referral program where existing clients can introduce potential new clients, subject to Apex Wealth Management conducting comprehensive due diligence on all referred individuals to assess suitability and manage potential conflicts of interest. Explanation. This scenario presents a professional challenge due to the inherent conflict between a firm's desire to expand its client base and the stringent regulatory obligations to ensure suitability and prevent conflicts of interest. The firm, Apex Wealth Management, must navigate the delicate balance of identifying potential new clients while upholding its fiduciary duty and adhering to the Financial Conduct Authority (FCA) regulations in the UK. The core of the challenge lies in ensuring that any new business development activities do not compromise the integrity of client advice or expose the firm to undue regulatory risk. The correct approach involves Apex Wealth Management proactively establishing clear, documented policies and procedures for identifying and onboarding new clients. This includes conducting thorough due diligence on prospective clients to assess their financial standing, investment objectives, and risk tolerance, ensuring alignment with the services Apex Wealth Management can legitimately offer. Furthermore, the firm must implement robust conflict of interest management procedures, particularly if the new business development involves introducing clients to third-party services or products. This approach is ethically sound and regulatorily compliant because it prioritizes client best interests, as mandated by the FCA's Principles for Businesses, specifically Principle 6, Customers' Interests, and Principle 7, Communications with Clients, and the Conduct of Business Sourcebook, COBS. It demonstrates a commitment to responsible business growth, underpinned by a strong control environment. An incorrect approach would be to pursue new business opportunities without a structured due diligence process. This could involve Apex Wealth Management encouraging its existing client base to refer potential new clients without a formal vetting mechanism for these referrals. This is ethically problematic as it risks onboarding clients who may not be suitable for the firm's services, potentially leading to poor investment outcomes and regulatory breaches. Specifically, it fails to meet the FCA's requirements for suitability assessments under COBS 9, which mandates that firms must ensure that any investment advice or service provided is suitable for the client. Another incorrect approach would be to delegate the entire responsibility for identifying and onboarding new clients to the sales team, without adequate oversight or adherence to established compliance protocols. This could lead to a focus on revenue generation at the expense of regulatory compliance and client protection. Such a failure would contravene FCA expectations for robust internal controls and the Senior Managers and Certification Regime, SM and CR, which places responsibility on senior individuals for ensuring compliance within their areas of control. A further incorrect approach would be to assume that any client referred by a trusted existing client is automatically suitable, bypassing the standard onboarding and suitability checks. This assumption is a dangerous shortcut that ignores the fundamental regulatory requirement for independent assessment of each client's individual circumstances. It creates a blind spot in the control framework and exposes Apex Wealth Management to significant regulatory risk, including potential fines and reputational damage, for failing to act with due skill, care, and diligence. The professional decision-making process for Apex Wealth Management should involve a risk-based approach. This means identifying potential new client segments, assessing the regulatory risks associated with each segment, and then designing and implementing controls that mitigate those risks effectively. This includes clear communication of policies to all staff, regular training, and ongoing monitoring of business development activities to ensure compliance with FCA rules and ethical standards. Question 5. Investigation of a situation at Apex Wealth Management, where a long-standing client, Mr. Harrison, has requested a series of complex, high-risk trades in an emerging market sector. While Mr. Harrison insists these trades align with his aggressive growth strategy, the junior advisor assigned to his account has concerns about the liquidity of the proposed instruments and the potential for significant capital loss, which may not be fully understood by the client. The firm's compliance department has flagged the transaction volume for enhanced scrutiny. What is the most appropriate course of action for Apex Wealth Management? Option A. Proceed with the trades as requested by Mr. Harrison, documenting his explicit instructions and understanding of the risks to maintain client satisfaction and avoid potential disputes. Option B. Advise Mr. Harrison to seek independent financial advice for these specific trades, as Apex Wealth Management may not have the expertise or risk appetite to handle such a request. Option C. Conduct a thorough review of Mr. Harrison's financial situation, risk tolerance, and investment objectives. Engage in a detailed discussion with him about the specific risks and potential downsides of the proposed trades, and explore alternative compliance strategies that align with his stated goals before making any decision. Option D. Decline the trades outright due to the junior advisor's concerns, informing Mr. Harrison that Apex Wealth Management cannot facilitate such risky transactions. The correct answer is A. Proceed with the trades as requested by Mr. Harrison, documenting his explicit instructions and understanding of the risks, to maintain client satisfaction and avoid potential disputes. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's stated wishes and the potential for those wishes to lead to regulatory breaches or unethical conduct. The firm, Apex Wealth Management must navigate this delicate situation by prioritizing its regulatory obligations and ethical duties over immediate client satisfaction. Careful judgment is required to balance client relationships with the imperative to uphold the integrity of financial advice and regulatory compliance. The correct approach involves a thorough understanding of the client's financial situation, objectives, and risk tolerance, followed by providing advice that is compliant with all relevant regulations and ethical standards. This approach prioritizes the client's best interests within the bounds of the law and professional conduct. Specifically, Apex Wealth Management must adhere to the principles of suitability and acting in the client's best interest, as mandated by regulatory frameworks governing financial advice. This means ensuring that any recommended course of action is appropriate for the client's circumstances and aligns with regulatory requirements, even if it means gently pushing back against the client's initial, potentially ill-informed, request. An incorrect approach would be to blindly follow the client's instructions without due diligence. This could lead to regulatory breaches, such as recommending unsuitable products or engaging in activities that violate anti-money laundering (AML) regulations or market abuse rules. Ethically, it would represent a failure to act in the client's best interest and a dereliction of professional duty. Another incorrect approach would be to dismiss the client's request outright without attempting to understand the underlying motivations or explore compliant alternatives. This could damage the client relationship and miss an opportunity to educate the client and guide them towards a more appropriate strategy. Finally, attempting to circumvent regulations to meet the client's request, even with the client's consent, is a serious ethical and regulatory failure, exposing both the client and Apex Wealth Management to significant risk. Professionals should employ a decision-making framework that begins with a comprehensive assessment of the client's needs and objectives. This should be followed by a thorough review of applicable regulations and ethical guidelines. If a client's request conflicts with these principles, the professional must engage in open and honest communication with the client, explaining the regulatory and ethical constraints and proposing compliant alternatives that still aim to meet the client's underlying goals. The ultimate decision must always be grounded in regulatory compliance and ethical responsibility. Question 6. The risk matrix shows a significant increase in the potential for market volatility impacting the proposed investment strategy for a key client of Apex Investments. The client has previously expressed a moderate risk tolerance. What is the most appropriate course of action for the Apex Investments advisor? Option A. Inform the client that the increased risk is a normal part of investing and no changes are necessary to the current strategy. Option B. Schedule an immediate meeting with the client to discuss the updated risk assessment, explain the potential implications of the increased volatility, and collaboratively revise the investment strategy to ensure it remains aligned with their risk tolerance and objectives. Option C. Immediately adjust the investment strategy to a more conservative allocation to mitigate all identified risks without further client consultation. Option D. Proceed with the original investment strategy, assuming the client is aware of general market risks and will accept the outcome. The correct answer is B. Schedule an immediate meeting with the client to discuss the updated risk assessment, explain the potential implications of the increased volatility, and collaboratively revise the investment strategy to ensure it remains aligned with their risk tolerance and objectives. Explanation. This scenario presents a professional challenge because it requires a nuanced understanding of how to interpret and act upon risk assessments within the specific regulatory environment of the IBEX hiring assessment test. The core difficulty lies in translating a visual representation of risk into concrete, compliant actions, ensuring that client interests and regulatory obligations are paramount. The firm, Apex Investments, must demonstrate its commitment to robust risk management and client protection, which are foundational principles tested in this assessment. The correct approach involves a proactive and documented engagement with the client regarding the identified risks. This means clearly communicating the nature of the risks, explaining their potential impact on the client's investment objectives, and collaboratively developing a revised strategy that aligns with the client's risk tolerance and regulatory requirements. This approach is correct because it upholds the principles of transparency, client suitability, and fiduciary duty, all of which are implicitly or explicitly mandated by the regulatory framework governing financial advisory services. Documenting this communication and the subsequent strategy adjustments provides a clear audit trail, demonstrating compliance with regulatory expectations for client understanding and consent. An incorrect approach would be to proceed with the investment strategy without further client consultation, assuming the client implicitly accepts the risks highlighted in the matrix. This fails to meet the regulatory requirement for ensuring client suitability and understanding, potentially exposing both the client and the firm to undue risk and regulatory scrutiny. Another incorrect approach would be to unilaterally alter the investment strategy to eliminate all identified risks without client input. While seemingly risk-averse, this disregards the client's stated objectives and risk tolerance, potentially leading to underperformance and dissatisfaction, and failing to act in the client's best interest. Finally, ignoring the risk matrix entirely and proceeding as originally planned would be a severe breach of professional duty and regulatory compliance, demonstrating a disregard for established risk management protocols and client protection. Professionals should approach such situations by first thoroughly understanding the risk matrix and its implications. They should then prioritize open and honest communication with the client, explaining the risks in clear, understandable terms. The decision-making process should involve a collaborative effort to adjust the investment strategy to align with the client's risk appetite and objectives, ensuring all actions are documented and justifiable under the relevant regulatory framework. Question 7. System analysis indicates that a long-standing client of Alpha Wealth Management, a firm regulated under the IBEX hiring assessment test jurisdiction, has requested the execution of a series of trades in a thinly traded stock. The client has provided specific instructions on the timing and volume of these trades, which, if executed as directed, could significantly influence the stock's price in a short period. The client has expressed a desire to make a splash in the market with this particular stock. What is the most appropriate course of action for Alpha Wealth Management? Option A. Refuse the client's instructions immediately and inform them that their request is not feasible due to regulatory concerns. Option B. Engage with the client to understand the rationale behind their trading strategy. Explain the potential regulatory implications of their requested execution pattern and explore alternative compliant methods to achieve their investment objectives. Option C. Execute the trades but immediately report the client's instructions to the relevant regulatory body as a potential attempt at market manipulation. Option D. Execute the trades precisely as instructed by the client, as the client is paying for the service and has the right to direct their investments. The correct answer is D. Execute the trades precisely as instructed by the client, as the client is paying for the service and has the right to direct their investments. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's explicit instructions and the firm's regulatory obligations and ethical duties. The firm, Alpha Wealth Management, must navigate the delicate balance of client service while upholding the integrity of financial markets and adhering to the stringent requirements of the IBEX hiring assessment test regulatory framework, which we will assume for this context aligns with UK financial services regulations and SISI guidelines. The core difficulty lies in ensuring that client instructions, even if seemingly straightforward, do not inadvertently lead to market abuse or breaches of regulatory reporting requirements. Careful judgment is required to identify potential red flags and to respond appropriately without alienating the client or compromising compliance. The correct approach involves a thorough understanding of the client's intent and a proactive assessment of the regulatory implications of their instructions. This means Alpha Wealth Management should not simply execute the trades as requested, but should first engage in a dialogue with the client to clarify their objectives and to educate them on any potential regulatory concerns. If the client's instructions, upon further clarification, still appear to pose a risk of market abuse or non-compliance, the firm has a professional and ethical duty to refuse the instruction and explain the regulatory basis for this refusal. This aligns with the principles of acting with integrity, due skill, care, and diligence, and maintaining the trust and confidence placed in them by the public and regulators, as emphasized in SISI Code of Conduct. Specifically, it addresses the duty to comply with all applicable laws, rules, regulations, and professional standards. An incorrect approach would be to blindly execute the client's instructions without due diligence. This failure to assess the regulatory implications of the trade, particularly concerning potential market manipulation or insider dealing, directly contravenes the regulatory framework. It demonstrates a lack of due skill, care, and diligence, and a disregard for the firm's responsibility to prevent market abuse. Another incorrect approach would be to refuse the instruction outright without attempting to understand the client's rationale or explaining the regulatory reasons for the refusal. This demonstrates poor client relationship management and a failure to act with integrity, as it could be perceived as unhelpful or obstructive without proper justification. A third incorrect approach might be to execute the trade, but then attempt to rectify any subsequent regulatory issues, which is a reactive and irresponsible stance that prioritizes expediency over proactive compliance and demonstrates a fundamental misunderstanding of the preventative nature of regulatory obligations. The professional decision-making process for similar situations should involve a structured approach. First, understand the client's request and underlying intent. Second, assess the request against all relevant regulatory requirements, including those pertaining to market abuse, insider dealing, and reporting obligations. Third, if any concerns arise, engage in open and transparent communication with the client to clarify their intentions and explain any potential regulatory issues. Fourth, if the client's instructions remain problematic, politely but firmly refuse the instruction, providing clear and specific regulatory justifications. Finally, document all communications and decisions thoroughly. Question 8. When evaluating a request from a long-standing client of IBEX Wealth Management, Mr. Harrison, who has expressed a strong desire to invest a significant portion of his portfolio into a highly speculative, unproven technology startup, what is the most appropriate course of action for the IBEX Wealth Management advisor, given that Mr. Harrison has explicitly stated he understands the risks and wants to proceed regardless of the advisor's opinion? Option A. Conduct a thorough suitability assessment of Mr. Harrison's financial situation, objectives, and risk tolerance, and if the investment is deemed unsuitable, explain the reasons clearly to Mr. Harrison and propose alternative suitable investment options. Option B. Proceed with the investment as requested by Mr. Harrison, ensuring all relevant risk disclaimers are signed and documented. Option C. Decline the investment request outright without further discussion, citing the speculative nature of the startup. Option D. Immediately execute the investment as per Mr. Harrison's instructions to maintain client satisfaction, as he is a long-standing client. The correct answer is B. Proceed with the investment as requested by Mr. Harrison, ensuring all relevant risk disclaimers are signed and documented. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's explicit instructions and the firm's regulatory obligations. The firm, IBEX Wealth Management, must navigate the delicate balance of client service while adhering strictly to the regulatory framework governing financial advice. The core of the challenge lies in ensuring that any advice provided is suitable for the client, not merely a reflection of their immediate, potentially ill-informed desires. This requires a deep understanding of the client's financial situation, objectives, and risk tolerance, as mandated by regulatory principles. The correct approach involves a thorough assessment of the client's circumstances and a clear explanation of why the requested investment may not be suitable, offering alternatives that align with regulatory requirements for suitability. This aligns with the core principles of client protection and responsible financial advice embedded within the regulatory framework. Specifically, it upholds the duty to act in the client's best interests and to ensure that recommendations are suitable, preventing the firm from facilitating potentially detrimental financial decisions. An incorrect approach that blindly follows the client's instruction without due diligence fails to meet the regulatory standard of care. This would constitute a breach of the duty to assess suitability and could expose both the client and the firm to undue risk, potentially leading to regulatory sanctions. Another incorrect approach, which involves simply refusing the client's request without providing a reasoned explanation or offering suitable alternatives, demonstrates poor client relationship management and may not fully satisfy the regulatory expectation of providing appropriate guidance. A third incorrect approach, which involves proceeding with the investment but attempting to mitigate risk through excessive disclaimers, is ethically questionable, and regulators often view such disclaimers as insufficient to absolve a firm of its primary suitability obligations. Professionals should approach such situations by first actively listening to the client's request and understanding their rationale. Subsequently, They must engage in a comprehensive fact-finding process to gather all necessary information to assess suitability. If the client's request is deemed unsuitable, the professional must clearly articulate the reasons for this assessment, referencing regulatory principles and the client's own financial profile, and then proactively propose alternative, suitable recommendations. This structured approach ensures compliance, protects the client, and maintains the firm's professional integrity. Question 9. The risk matrix shows a moderate likelihood of a significant impact related to potential breaches of client money regulations at Sterling Investments Limited. The identified risk stems from a new automated trading system that has not undergone a full independent review of its compliance controls. The head of trading is concerned about the potential delay in launching the new system if a full review is mandated, which could impact quarterly bonus targets. Which of the following is the most appropriate course of action for the compliance officer at Sterling Investments Limited? Option A. Proceed with the launch of the new trading system as planned, with a commitment to conduct a review of its compliance controls within the next 6 months. Option B. Inform the head of trading that the system launch must be delayed until a full independent review is completed, and suggest they discuss the impact on bonus targets with HR. Option C. Immediately halt the deployment of the new trading system and initiate a full independent review of its compliance controls, escalating the findings to senior management and the board. Option D. Advise the head of trading to implement a temporary manual override for client money transactions until the automated system's compliance controls can be reviewed. The correct answer is C. Immediately halt the deployment of the new trading system and initiate a full independent review of its compliance controls, escalating the findings to senior management and the board. Explanation. This scenario presents a professional challenge because it requires an individual to balance the immediate financial implications of a potential regulatory breach against the long-term reputational and legal consequences. The IBEX hiring assessment test is designed to evaluate a candidate's ability to navigate such complex situations by applying regulatory knowledge and ethical judgment. The core of the challenge lies in identifying and prioritizing compliance obligations, even when faced with pressure to achieve business objectives. The correct approach involves a proactive and thorough assessment of the identified risk, followed by the implementation of appropriate controls and escalation to relevant internal stakeholders. This demonstrates a commitment to regulatory adherence and a responsible approach to risk management. Specifically, it aligns with the principles of good corporate governance and the regulatory expectation that firms will identify, assess, and mitigate risks to compliance. This approach prioritizes the integrity of the firm's operations and its adherence to the spirit and letter of the law, which is paramount in the financial services industry. An incorrect approach that focuses solely on the financial impact without addressing the underlying compliance issue would be professionally unacceptable. This failure stems from a disregard for regulatory requirements and an overemphasis on short-term financial gains, potentially leading to significant penalties, reputational damage, and loss of client trust. Another incorrect approach that involves ignoring the risk altogether or delaying action would also be a serious ethical and regulatory failure. Such inaction suggests a lack of diligence and a failure to uphold the professional duty of care, exposing the firm to greater harm. A third incorrect approach that involves attempting to circumvent the regulatory process or misrepresent the situation would constitute a direct breach of ethical conduct and potentially illegal activity. Professionals should approach such situations by first understanding the nature and severity of the identified risk through a comprehensive assessment. This should be followed by consulting relevant internal policies, procedures, and regulatory guidance. If the risk involves a potential breach of regulations, the appropriate course of action is to escalate the matter to the compliance department or designated senior management for further investigation and remediation. The decision-making process should be guided by a commitment to integrity, transparency, and adherence to the regulatory framework, prioritizing the long-term health and reputation of the firm over short-term expediency. Question 10. Analysis of a situation where Sarah, a financial advisor at IBEX Capital, is assisting a client, Mr. Davies, in selecting a new investment platform. Sarah's close friend, Mark, recently launched a new, innovative investment platform. Mr. Davies has expressed interest in exploring new platforms. Sarah is aware that Mark's platform offers competitive fees and potentially unique investment opportunities. However, she has not yet conducted a formal due diligence on Mark's platform beyond her personal knowledge of Mark's capabilities. What is the most appropriate course of action for Sarah to take in this scenario, adhering strictly to the regulatory framework and ethical guidelines relevant to the IBEX hiring assessment test? Option A. Sarah should recommend Mark's platform to Mr. Davies immediately, given her personal trust in Mark and the platform's perceived advantages. Option B. Sarah should conduct a thorough, objective due diligence on Mark's platform, comparing it against other suitable alternatives, and disclose her personal relationship with Mark to Mr. Davies before making any recommendation. Option C. Sarah should suggest Mr. Davies explore Mark's platform independently without any input or recommendation from her, to maintain complete objectivity. Option D. Sarah should avoid recommending Mark's platform altogether to prevent any appearance of impropriety, even if it might be the best option for Mr. Davies. The correct answer is A. Sarah should recommend Mark's platform to Mr. Davies immediately, given her personal trust in Mark and the platform's perceived advantages. Explanation: this scenario presents a professional challenge for an IBEX hiring assessment test candidate by requiring them to navigate a situation involving potential conflicts of interest and the ethical duty to act in the best interests of clients, all within the specific regulatory framework of the IBEX exam's jurisdiction. The core difficulty lies in balancing personal relationships with professional obligations and understanding the nuances of disclosure and client prioritization. Careful judgment is required to ensure compliance with regulatory standards and maintain client trust. The correct approach involves prioritizing the client's interests above all else, even when faced with a personal connection to a potential service provider. This means conducting a thorough, objective assessment of the proposed service provider's suitability based on the client's needs and the provider's qualifications, without undue influence from the personal relationship. Regulatory and ethical guidelines mandate that financial professionals act with integrity and in the best interests of their clients. This includes avoiding conflicts of interest or, if unavoidable, managing them transparently and effectively, ensuring that client decisions are based on objective merit rather than personal connections. An incorrect approach would be to recommend the service provider solely based on the personal relationship, without a rigorous objective evaluation. This fails to uphold the duty to act in the client's best interests and could lead to a suboptimal outcome for the client, potentially violating regulatory requirements concerning client suitability and fiduciary duty. Another incorrect approach would be to fail to disclose the personal relationship to the client. This lack of transparency erodes trust and prevents the client from making a fully informed decision, which is a clear ethical and regulatory breach. Recommending the service provider without considering alternative options also demonstrates a failure to act in the client's best interests, as it limits the client's choices and may not secure the most advantageous service. Professionals should employ a decision-making framework that begins with identifying potential conflicts of interest. They must then assess the impact of these conflicts on their ability to act impartially and in the client's best interests. Transparency and disclosure are paramount. Any personal relationships that could influence professional judgment must be disclosed to the client. The subsequent decision-making process must be objective, evidence-based, and always prioritize the client's needs and objectives over personal considerations or convenience. Question 11. The efficiency study reveals that the current manual reconciliation process for client trades at Alpha Investments Limited is time-consuming and prone to human error, leading to potential delays in reporting. The head of operations is keen to implement a new automated system to streamline this process. However, the compliance department has raised concerns about the data security and audit trail capabilities of some of the proposed software solutions. Which of the following represents the most professionally responsible course of action for Alpha Investments Limited to address the identified inefficiencies while adhering to regulatory requirements? Option A. Delegate the decision-making for the new system entirely to the IT department, trusting their technical expertise to select the best solution without further input from operations or compliance. Option B. Halt all efforts to automate the reconciliation process until a perfect, fully compliant, and zero-risk solution can be identified, even if it means continuing with the inefficient manual process indefinitely. Option C. Implement the most cost-effective automated system immediately to address the efficiency concerns, with a plan to address any compliance issues that may arise later. Option D. Conduct a thorough due diligence process on all proposed automated systems, prioritizing those that offer robust data security and comprehensive audit trails, and consult closely with the compliance department to ensure full adherence to all relevant regulations before implementation. Correct answer is C. Implement the most cost-effective automated system immediately to address the efficiency concerns, with a plan to address any compliance issues that may arise later. Explanation. This scenario presents a professional challenge because it requires balancing the company's desire for efficiency with its regulatory obligations and ethical responsibilities. The IBEX hiring assessment test, in its focus on regulatory compliance and professional conduct, expects candidates to demonstrate an understanding of how to navigate such situations without compromising integrity or legal standing. Careful judgment is required to identify and implement solutions that are both effective and compliant. The correct approach involves proactively addressing the identified inefficiencies by exploring all available compliance solutions, including potential technological upgrades or process reengineering, while ensuring that any proposed changes strictly adhere to the regulatory framework governing financial services operations. This approach is professionally sound because it prioritizes regulatory adherence and ethical conduct. Specifically, it aligns with the principles of good governance and risk management expected of firms operating within regulated environments. By seeking to improve efficiency through compliant means, the company demonstrates a commitment to both operational excellence and its legal duties, thereby safeguarding its reputation and avoiding potential penalties. An incorrect approach that focuses solely on cost reduction without considering regulatory implications would be professionally unacceptable. This failure stems from a disregard for the legal and ethical obligations that underpin financial services. Such an approach risks breaching regulations designed to protect investors and maintain market integrity, leading to significant fines, reputational damage, and potential legal action. Another incorrect approach that involves implementing changes without adequate due diligence or consultation with compliance departments is also professionally unsound. This oversight can lead to unintended regulatory breaches, as new processes may inadvertently violate specific rules or guidelines. The failure here lies in bypassing established risk management protocols and failing to leverage internal expertise, which is crucial for ensuring ongoing compliance. The professional decision-making process for similar situations should involve a structured approach. First, clearly identify the inefficiency and its potential impact. Second, thoroughly research and understand all relevant regulatory requirements and ethical considerations. Third, brainstorm a range of potential solutions, evaluating each against both efficiency goals and compliance standards. Fourth, consult with relevant internal departments such as compliance and legal to validate proposed solutions. Finally, implement the chosen solution with robust monitoring to ensure continued adherence to regulations and ethical principles. Question 12. Stakeholder feedback indicates that IBEX Financial Services has recently acquired a significant minority stake in a direct competitor. As a senior financial advisor at IBEX, you are aware that this investment could create a perceived or actual conflict of interest when advising clients on investment strategies that might involve products or services offered by the competitor. What is the most appropriate course of action to uphold regulatory compliance and ethical standards? Option A. Continue advising clients as usual, assuming that IBEX existing internal compliance policies are sufficient to manage any potential conflicts without the need for specific client notification regarding this particular investment. Option B. Prioritize recommendations that are likely to benefit IBEX investment in the competitor, while still providing a range of options to clients to ensure the company's financial objectives are met alongside client needs. Option C. Immediately cease recommending any products or services from the competitor to clients without prior consultation or specific client consent to avoid any appearance of impropriety. Option D. Proactively disclose IBEX investment in the competitor to all affected clients, clearly explaining the potential implications and reaffirming that all advice will continue to be solely based on their individual best interests and suitability, with robust internal controls in place to ensure independence. The correct answer is D. Proactively disclose IBEX investment in the competitor to all affected clients, clearly explaining the potential implications and reaffirming that all advice will continue to be solely based on their individual best interests and suitability, with robust internal controls in place to ensure independence. Explanation: this scenario presents a professional challenge for an IBEX hiring assessment test candidate by requiring them to navigate a situation involving potential conflicts of interest and the ethical duty to act in the best interests of clients, all within the context of the UK regulatory framework and SISI guidelines. The core difficulty lies in balancing the company's commercial objectives with the fiduciary responsibilities owed to clients. Careful judgment is required to identify and manage potential conflicts that could compromise client outcomes or the integrity of IBEX advisory services. The correct approach involves proactively identifying the potential conflict of interest arising from IBEX investment in a competitor, and then implementing robust measures to mitigate any adverse impact on client advice. This includes transparent disclosure to clients about the relationship and the potential for bias, and ensuring that all investment recommendations are made solely based on the client's best interests, independent of IBEX stake in the competitor. This aligns with the SISI Code of Conduct, which emphasizes acting with integrity, due skill, care, and diligence, and avoiding conflicts of interest or disclosing them and managing them appropriately. Specifically, Principle 2 of the SISI Code requires members to act honestly, fairly, and with integrity in all dealings with clients, and Principle 3 mandates acting in the best interests of clients. An incorrect approach would be to ignore the potential conflict, assuming that IBEX internal policies are sufficient without explicit client disclosure. This fails to meet the ethical obligation of transparency and could lead to clients making investment decisions without full awareness of potential influences, thereby breaching the duty to act in their best interests. Another incorrect approach would be to cease all recommendations related to the competitor's products without proper client consultation or a clear, documented rationale based on client suitability. This could be seen as an overreaction that potentially disadvantages clients by limiting their investment options without a valid, client-centric reason. Finally, an approach that prioritizes IBEX financial gain from its investment over client suitability would be a severe ethical and regulatory breach, directly contravening the fundamental principle of putting clients first. Professionals should employ a decision-making framework that begins with identifying potential conflicts of interest. This should be followed by an assessment of the severity and nature of the conflict. The next step is to consult relevant regulatory requirements and ethical codes, in this case, UK regulations and SISI guidelines. Based on this assessment, appropriate mitigation strategies, including disclosure and client consultation, should be implemented. The overarching principle should always be to prioritize the client's best interests and maintain the integrity of the advisory relationship. Question 13. Research into a recent client onboarding at Apex Wealth Management has revealed a request from a high net worth individual to transfer a substantial sum of funds from an overseas account with limited transparency regarding the source of these funds. The client has expressed impatience with the standard due diligence procedures, stating that they have a long-standing relationship with the firm and expect their instructions to be prioritized. Apex Wealth Management's compliance department has flagged the transaction as potentially high risk due to the lack of clear documentation and the jurisdiction of origin. Which of the following approaches should Apex Wealth Management adopt in response to this situation? Option A. Immediately proceed with the fund transfer as requested by the client, given their stated impatience and long-standing relationship, to maintain client satisfaction. Option B. Conduct a thorough internal review of the client's request, seeking further clarification on the source of funds and the purpose of the transfer, while explaining the necessity of due diligence procedures and exploring alternative compliant methods for the transfer. Option C. Inform the client that their request cannot be fulfilled due to the lack of transparency and terminate the relationship immediately without further discussion. Option D. Delegate the decision to a junior compliance officer to expedite the process and avoid direct confrontation with the client. The correct answer is A. Immediately proceed with the fund transfer as requested by the client, given their stated impatience and long-standing relationship, to maintain client satisfaction. Explanation: this scenario presents a professional challenge due to the inherent conflict between a client's stated wishes and the potential for those wishes to lead to regulatory breaches or unethical conduct. The firm, Apex Wealth Management must navigate this delicate situation by prioritizing its regulatory obligations and ethical duties above all else, even when faced with a potentially lucrative client relationship. The core of the challenge lies in balancing client service with compliance and integrity. The correct approach involves a thorough, documented internal review of the client's request against all applicable regulations and Apex Wealth Management's internal policies. This includes seeking clarification from the client on the rationale behind their request and exploring alternative compliance solutions. This approach is professionally sound because it demonstrates a commitment to regulatory adherence, client protection, and ethical conduct. Specifically, it aligns with the principles of Know Your Client, KIC, and anti-money laundering, AML regulations, which require firms to understand the source of funds and the purpose of transactions. It also upholds the ethical duty of professional integrity, ensuring that Apex Wealth Management does not facilitate or condone potentially illicit activities. An incorrect approach would be to immediately proceed with the client's request without due diligence. This would be a significant regulatory failure, as it bypasses essential checks and balances designed to prevent financial crime and protect the integrity of the financial system. Ethically, it would demonstrate a disregard for professional responsibility and could expose the firm and its employees to severe penalties, reputational damage, and legal repercussions. Another incorrect approach would be to dismiss the client's request outright without attempting to understand their motivations or explore compliant alternatives. While caution is necessary, an overly rigid or uncommunicative stance can damage client relationships and may not be the most effective way to achieve regulatory compliance if the client's underlying intent is legitimate but poorly articulated. This approach fails to uphold the principle of providing appropriate advice and service within regulatory boundaries. A third incorrect approach would be to delegate the decision-making entirely to junior staff without adequate oversight or guidance. This is a failure of management responsibility and a potential regulatory breach, as senior management is ultimately accountable for ensuring compliance. It also fails to leverage the expertise and judgment of experienced professionals who are better equipped to assess complex situations and make informed decisions. The professional decision-making process for similar situations should involve a structured, risk-based approach. First, identify and understand the client's request and its potential implications. Second, consult relevant regulatory frameworks, internal policies, and legal counsel. Third, engage in open and transparent communication with the client to clarify their intentions and explore compliant options. Fourth, document all discussions, decisions, and actions taken. Finally, escalate complex or high-risk situations to senior management or compliance departments for review and approval. Question 14. The risk matrix shows a moderate risk of misrepresentation associated with a specific client request at Apex Wealth Management. The client, Mr. Harrison, has explicitly asked for an investment strategy that, based on his stated financial situation and risk tolerance, appears to be overly aggressive and potentially unsuitable. He has emphasized his desire for rapid capital growth above all else. Which of the following represents the most appropriate course of action for the Apex Wealth Management advisor? Option A. Engage Mr. Harrison in a detailed discussion to understand the underlying motivations for his aggressive growth objective. Explain the potential risks and downsides of his requested strategy in relation to his stated financial situation, and explore alternative strategies that align better with his overall risk tolerance and long-term financial goals while documenting this process thoroughly. Option B. Inform Mr. Harrison that his request cannot be fulfilled due to regulatory restrictions, and advise him to seek financial advice elsewhere if he insists on such an aggressive strategy. Option C. Proceed with Mr. Harrison's requested investment strategy, documenting his explicit instruction to override any suitability concerns, and focus on highlighting the potential for high returns. Option D. Implement a slightly modified version of Mr. Harrison's requested strategy that Apex Wealth Management deems marginally less risky, without explicitly detailing the remaining risks to Mr. Harrison, to satisfy his immediate request. The correct answer is C. Proceed with Mr. Harrison's requested investment strategy, documenting his explicit instruction to override any suitability concerns, and focus on highlighting the potential for high returns. Explanation: this scenario presents a professional challenge due to the inherent conflict between a client's stated preference and the firm's regulatory obligations. The firm, Apex Wealth Management, must navigate the delicate balance of client service and compliance with the IBEX hiring assessment tests regulatory framework. The risk matrix, indicating a moderate risk of misrepresentation, necessitates a cautious and principled approach. Careful judgment is required to ensure that client interests are protected without compromising ethical standards or regulatory adherence. The correct approach involves a thorough, documented assessment of the client's understanding and capacity to make informed decisions, followed by a clear communication of the firm's limitations and regulatory responsibilities. This approach prioritizes client well-being and regulatory compliance by ensuring that any recommended investment strategy is suitable and that the client fully comprehends the associated risks and benefits. Specifically, it aligns with the IBEX framework's emphasis on client suitability, transparency, and the prevention of misrepresentation. By seeking to understand the client's true intentions and educating them on the implications of their request, Apex Wealth Management acts in accordance with its fiduciary duty and regulatory mandates. An incorrect approach would be to proceed with the client's request without further investigation, assuming their stated preference is fully informed and appropriate. This would fail to address the moderate risk identified in the matrix and could lead to a breach of suitability rules, potentially exposing the client to unsuitable investments and the firm to regulatory sanction for failing to conduct adequate due diligence. Another incorrect approach would be to dismiss the client's request outright without attempting to understand the underlying reasons or to educate them on alternatives. This could damage the client relationship and might overlook a legitimate, albeit poorly articulated, client need. While avoiding regulatory breaches, it falls short of providing comprehensive client service. A third incorrect approach would be to proceed with the request, but to downplay or omit any mention of the identified risks in client communications. This constitutes a direct violation of transparency requirements and could be construed as misrepresentation, directly contravening the moderate risk flagged in the matrix and the core principles of ethical conduct. The professional decision-making process for similar situations should involve a structured approach. 1. Identify and assess the risk. Recognize any red flags or potential conflicts, as highlighted by the risk matrix. 2. Understand the client's needs and intentions. Engage in open dialogue to ascertain the true objectives behind the client's request. 3. Evaluate against regulatory and ethical standards. Determine if the client's request aligns with suitability rules, disclosure obligations, and the firm's code of conduct. 4. Communicate clearly and transparently. Explain any limitations, risks, and regulatory constraints to the client. 5. Document all interactions and decisions. Maintain a comprehensive record of discussions, assessments, and actions taken. 6. Seek internal guidance if necessary. Consult with compliance or senior management when faced with complex or ambiguous situations. Question 15. Comparative studies suggest that effective client acquisition in the financial services sector requires a delicate balance between demonstrating expertise and upholding stringent confidentiality protocols. Imagine you are a financial advisor at IBEX, a prominent investment firm. A prospective client, who is a competitor's former client, expresses interest in IBEX services. During your initial conversation, they inquire about the specific proprietary research IBEX has recently conducted on emerging technology sectors and ask how this research has informed IBEX investment strategies for its current clients. How should you, as an IBEX representative, ethically and compliantly respond to this inquiry? Option A. Offer to provide the prospective client with a redacted version of IBEX proprietary research report, highlighting key conclusions but omitting sensitive details to demonstrate the depth of IBEX analytical work. Option B. Share details of IBEX proprietary research findings and specific investment recommendations made to current clients, explaining how these have led to successful outcomes to impress the prospective client with IBEX capabilities. Option C. Discuss the general themes and broad market trends identified in IBEX recent research without revealing specific proprietary data, client names, or investment decisions made for existing clients, while emphasizing IBEX commitment to rigorous research and client confidentiality. Option D. Politely decline to answer the question, stating that IBEX does not discuss its research or client strategies with prospective clients, and offer to provide general information about IBEX services. The correct answer is C. Discuss the general themes and broad market trends identified in IBEX recent research without revealing specific proprietary data, client names, or investment decisions made for existing clients, while emphasizing IBEX commitment to rigorous research and client confidentiality. Explanation: this scenario presents a professional challenge for an IBEX hiring assessment test candidate by requiring them to navigate potential conflicts of interest and maintain client confidentiality within a simulated financial advisory context. The core difficulty lies in balancing the duty to provide objective advice with the desire to foster positive relationships with both existing and prospective clients, while adhering to strict regulatory requirements. Careful judgment is paramount to avoid actions that could be perceived as unethical or illegal. The correct approach involves prioritizing the client's best interests and adhering strictly to IBEX internal policies and relevant regulatory guidelines regarding client information and potential conflicts. This means refraining from sharing confidential information about IBEX proprietary research or client strategies with the prospective client, even if it seems beneficial for securing new business. Instead, the focus should be on demonstrating IBEX capabilities through publicly available information or general market insights, while clearly communicating the firm's commitment to confidentiality and ethical conduct. This aligns with regulatory principles that mandate client protection, fair dealing, and the prevention of insider trading or the misuse of non-public information. An incorrect approach would be to share any non-public information about IBEX research or existing client dealings with the prospective client. This constitutes a breach of confidentiality, potentially violates data protection regulations, and could be construed as an unfair advantage or even insider dealing if the information is market sensitive. Another incorrect approach would be to dismiss the prospective client's inquiry outright without exploring legitimate avenues for engagement. This could be seen as poor client relationship management and a missed opportunity, but more importantly, it fails to uphold the professional duty to engage with potential clients in a manner that is both informative and compliant. Third incorrect approach would be to make promises or guarantees about future investment performance based on proprietary insights. This is misleading, unethical, and likely violates regulations against making unsubstantiated claims or guarantees in financial advice. Professionals should employ a decision-making framework that begins with identifying the core ethical and regulatory obligations. This involves understanding the firm's code of conduct, relevant laws, and the specific duties owed to clients. When faced with a situation involving potential conflicts or the use of sensitive information, the professional should ask, does this action uphold my duty of care and confidentiality to all parties involved? And does this action comply with all applicable regulations and firm policies? If there is any doubt, seeking guidance from a supervisor or compliance department is the most prudent step. The principle of client's best interest first and strict adherence to regulatory frameworks should always guide decision-making. Question 16. The risk matrix shows a potential conflict of interest for IBEX Wealth Management regarding a client's request to invest a significant portion of their portfolio in a highly speculative, illiquid asset class that is not aligned with their stated long-term retirement goals. The client has expressed a strong personal conviction about this investment's potential for rapid growth. IBEX Wealth Management's internal compliance department has flagged this as a high-risk scenario due to potential regulatory scrutiny regarding suitability and best execution. Which of the following approaches best demonstrates IBEX Wealth Management's adherence to regulatory requirements and professional ethics in this situation? Option A. Advise the client that while the investment is speculative, IBEX Wealth Management can facilitate it if the client signs a waiver acknowledging the risks, thereby absolving the firm of responsibility. Option B. Engage in a detailed discussion with the client to understand the rationale behind their preference, assess the suitability of the proposed investment against their stated financial goals and risk tolerance, and if deemed unsuitable, propose alternative investments that align with their objectives and regulatory standards. Option C. Decline the client's request outright, citing the speculative nature of the asset class and the potential for losses, without further discussion or exploration of alternatives. Option D. Proceed with the client's requested investment, as the client has explicitly directed it and IBEX Wealth Management has documented the client's conviction. Correct answer is D. Proceed with the client's requested investment, as the client has explicitly directed it and IBEX Wealth Management has documented the client's conviction. Explanation: this scenario presents a professional challenge due to the inherent conflict between a client's stated preference and the firm's regulatory obligations. The firm, Apex Wealth Management, must navigate the delicate balance of client service while adhering strictly to the regulatory framework governing financial advice. The risk matrix, by highlighting potential conflicts of interest, serves as a crucial tool for identifying and mitigating such challenges. The professional judgment required here lies in prioritizing regulatory compliance and client best interests over immediate client satisfaction or potential revenue generation. The correct approach involves a thorough assessment of the client's stated preference against the regulatory requirements for suitability and best execution. This means Apex Wealth Management must first understand the underlying reasons for the client's request and then objectively evaluate whether the proposed investment aligns with the client's financial objectives, risk tolerance, and overall financial situation, as mandated by regulatory guidelines. If the proposed investment, despite the client's preference, is deemed unsuitable or not in the client's best interest according to regulatory standards, the firm has a professional and ethical duty to explain these concerns clearly and recommend alternative, suitable options. This upholds the principle of acting in the client's best interest, a cornerstone of financial regulation. An incorrect approach would be to blindly follow the client's instructions without due diligence. This failure to assess suitability and best execution directly contravenes regulatory mandates that require financial advisors to ensure investments are appropriate for their clients. Another incorrect approach would be to dismiss the client's preference outright without attempting to understand their rationale or offering suitable alternatives. This could be perceived as poor client service and may not fully explore options that could genuinely meet the client's underlying needs within regulatory boundaries. Finally, prioritizing the potential for higher commission or fees associated with the client's preferred investment over regulatory compliance would be a severe ethical and regulatory breach, demonstrating a conflict of interest that has not been properly managed. The professional decision-making process in such situations should involve a structured approach. 1. Identify the potential conflict. Recognize when a client's request might clash with regulatory requirements or the firm's ethical obligations. 2. Gather information. Understand the client's motivations, financial situation, and objectives. 3. Regulatory assessment. Evaluate the proposed action against all applicable regulations, focusing on suitability, best execution, and client best interests. 4. Professional judgment. Apply expertise and ethical principles to determine the most appropriate course of action. 5. Clear communication. Explain the rationale behind the decision to the client, offering transparent explanations and alternative solutions where necessary. 6. Documentation. Maintain thorough records of the assessment, decision-making process, and client communications. Question 17. Regulatory review indicates that Apex Wealth Management has received a request from a long-standing client, Mr. Harrison, to restructure a portion of his investment portfolio in a manner that, while potentially maximizing short-term gains, appears to skirt the spirit of certain disclosure requirements outlined in the IBEX hiring assessment tests regulatory framework. Mr. Harrison has explicitly stated he wishes to proceed with this specific structure. What is the most appropriate course of action for the Apex Wealth Management advisor? Option A. Proceed with the client's requested portfolio restructuring, as the client has the ultimate authority over their investments and has explicitly consented. Option B. Decline the client's request immediately and inform Mr. Harrison that his proposed strategy is not compliant with regulatory guidelines without further discussion. Option C. Engage in a detailed discussion with Mr. Harrison to fully understand his objectives, explain the specific regulatory concerns and potential implications of his proposed strategy, and explore alternative, compliant methods to achieve his goals. Option D. Advise Mr. Harrison on how to structure the transaction to technically meet the letter of the law, even if it appears to circumvent the intended purpose of the disclosure requirements. The correct answer is A. Proceed with the client's requested portfolio restructuring, as the client has the ultimate authority over their investments and has explicitly consented. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's stated wishes and the potential for those wishes to lead to regulatory noncompliance or unethical conduct. The firm, Apex Wealth Management, must navigate the delicate balance of client service while upholding its fiduciary duties and adhering strictly to the IBEX hiring assessment test's regulatory framework. Careful judgment is required to ensure that client instructions are understood, assessed for compliance, and addressed appropriately without compromising professional integrity or regulatory obligations. The correct approach involves a thorough understanding of the client's objectives, a diligent assessment of the regulatory implications of those objectives, and a clear, documented communication with the client regarding any potential conflicts or limitations. This approach is correct because it prioritizes regulatory compliance and ethical conduct, which are paramount in the financial services industry. Specifically, it aligns with the principles of acting in the client's best interest while adhering to all applicable laws and regulations, as mandated by the IBEX framework. This involves proactive identification of risks and transparent discussion with the client. An incorrect approach would be to blindly follow the client's instructions without due diligence. This fails to uphold the professional's responsibility to ensure all actions are compliant with the regulatory framework. Another incorrect approach would be to dismiss the client's request outright without attempting to understand the underlying intent or explore compliant alternatives. This demonstrates a lack of client service and a failure to explore all avenues to meet client needs within regulatory boundaries. Finally, attempting to circumvent regulations to meet the client's request, even with the client's consent, is a severe ethical and regulatory breach. Professionals should employ a decision-making framework that begins with active listening and understanding the client's goals. This is followed by a comprehensive assessment of the regulatory landscape relevant to those goals. If a conflict arises, the professional should clearly articulate the regulatory constraints and ethical considerations to the client, and then collaboratively explore compliant solutions. Documentation of all discussions and decisions is crucial. Question 18. Consider a scenario where a client of IBEX Investments, a firm regulated in the UK, requests an unusual and complex series of international wire transfers to a jurisdiction known for its high risk of money laundering. The client is evasive when asked for the purpose of these transfers. As an IBEX employee, what is the most appropriate course of action to uphold both client service and regulatory compliance? Option A. Immediately file a suspicious activity report (SAR) with the National Crime Agency (NCA) without consulting internal compliance. Option B. Discreetly escalate the matter to IBEX Money Laundering Reporting Officer (MLRO) or Compliance Department for guidance and assessment. Option C. Confront the client directly about the suspicions and demand a detailed explanation before taking any further action. Option D. Proceed with the wire transfers as requested by the client, as the firm's primary duty is to facilitate client transactions. The correct answer is A. Immediately file a suspicious activity report (SAR) with the National Crime Agency (NCA) without consulting internal compliance. Explanation. Scenario analysis. This scenario presents a professional challenge for an IBEX employee due to the inherent conflict between client confidentiality and the regulatory obligation to report suspicious activity. The employee must navigate the delicate balance of protecting client trust while upholding legal and ethical standards. Failure to act appropriately could result in severe regulatory penalties for IBEX and reputational damage, alongside potential personal repercussions. The pressure to maintain client relationships must not override the paramount duty to comply with regulations. Correct approach analysis. The correct approach involves discreetly escalating the matter internally to the designated compliance officer or MLRO. This is the right professional practice because it adheres to IBEX internal policies and regulatory frameworks, such as those mandated by the Financial Conduct Authority, FCA, in the UK. The FCA's money laundering regulations require firms to have robust systems and controls in place to prevent money laundering and terrorist financing. Reporting internally ensures that the suspicion is handled by trained professionals who can assess the situation, gather further information if necessary, and make an informed decision on whether to file a suspicious activity report (SAR) with the National Crime Agency (NCA). This process protects client confidentiality as much as possible while fulfilling the legal obligation to report. Incorrect approach is analysis. Disregarding the client's request and immediately filing a SAR without internal consultation is an incorrect approach. While the intention might be to comply with regulations, it bypasses internal reporting structures, potentially causing unnecessary alarm or misinterpreting the situation. It also risks breaching client confidentiality prematurely and could lead to an improperly filed SAR, which can have negative consequences. Ignoring the client's unusual request and continuing with the transaction without any further inquiry is a significant regulatory and ethical failure. This approach demonstrates a lack of due diligence and a failure to identify and report potential money laundering activities, directly contravening the FCA's expectations for firms to be vigilant. It prioritizes transactional ease over regulatory compliance and client safety. Directly confronting the client about the suspicion and demanding an explanation before reporting is also an incorrect approach. This action could tip off the client, allowing them to destroy evidence or further conceal their activities, thereby obstructing a potential investigation. It also constitutes a breach of confidentiality and could jeopardize the firm's ability to comply with its reporting obligations. Professional reasoning. Professionals facing such a situation should follow a structured decision-making process. First, recognize the potential red flags and the conflict between client service and regulatory obligations. Second, consult IBEX internal policies and procedures regarding suspicious activity and client confidentiality. Third, escalate the concern to the appropriate internal authority, e.g., compliance officer, MLRO, for assessment and guidance. Fourth, act only on the advice of the compliance department regarding any external reporting. This systematic approach ensures that all regulatory requirements are met, client confidentiality is respected to the extent possible, and the firm's integrity is maintained. Question 19. The risk matrix shows a moderate likelihood of a new product offering by Sterling Wealth Management exceeding regulatory thresholds for client suitability, with a high potential impact on client financial well-being and the firm's regulatory standing. The head of sales has suggested a phased rollout, arguing that initial data will be insufficient to confirm the risk, and that delaying the launch would significantly impact quarterly revenue targets. What is the most appropriate course of action for the compliance officer? Option A. Proceed with the phased rollout as suggested by the head of sales, assuming initial client feedback will mitigate any emerging suitability issues. Option B. Recommend an immediate halt to the product launch until further market research can definitively prove the product's suitability across all client segments. Option C. Focus on the revenue impact, suggesting that the sales team implement additional disclaimers to manage potential client complaints. Option D. Advocate for a comprehensive pre-launch risk assessment and robust monitoring plan, even if it delays the rollout and impacts short-term revenue. The correct answer is D. Advocate for a comprehensive pre-launch risk assessment and robust monitoring plan, even if it delays the rollout and impacts short-term revenue. Explanation. This scenario presents a professional challenge because it requires an individual to balance the company's immediate financial interests with its long-term regulatory compliance and ethical obligations. The pressure to meet targets can create a temptation to overlook or downplay potential risks, making careful judgment and adherence to established frameworks paramount. The correct approach involves a thorough and objective assessment of the identified risks, prioritizing those that pose the greatest threat to client well-being and regulatory standing. This aligns with the core principles of responsible financial conduct, emphasizing client protection and adherence to the spirit and letter of regulations. Specifically, it reflects the duty of care owed to clients and the obligation to maintain the integrity of the financial markets. By escalating concerns through the appropriate channels and advocating for robust mitigation strategies, the individual upholds their professional responsibility and safeguards the firm from potential regulatory sanctions and reputational damage. This proactive stance is a cornerstone of ethical financial practice, ensuring that business decisions are informed by a comprehensive understanding of potential negative consequences. An incorrect approach that focuses solely on the immediate financial implications without adequately considering the regulatory and ethical dimensions fails to acknowledge the interconnectedness of these factors. Such an approach risks violating regulatory requirements designed to protect consumers and market stability, potentially leading to significant fines, reputational harm, and loss of client trust. Another incorrect approach that involves downplaying or ignoring the identified risks, perhaps due to pressure to meet targets, represents a dereliction of professional duty. This can lead to severe consequences, including regulatory enforcement action, client detriment, and personal disciplinary measures. It demonstrates a lack of integrity and a failure to uphold the standards expected of professionals in the financial services industry. The professional decision-making process in such situations should involve a structured approach. First, clearly identify and understand the risks presented in the risk matrix. Second, evaluate these risks against relevant regulatory requirements and ethical principles, considering the potential impact on clients, the firm, and the market. Third, determine the most appropriate course of action, which may involve implementing mitigation strategies, escalating concerns to senior management or compliance departments, or seeking further guidance. Finally, document all assessments and decisions meticulously to provide a clear audit trail and demonstrate due diligence. Question 20. The investigation demonstrates that Apex Wealth Management has been approached by a long-standing, high-net-worth client who is expressing a strong desire to invest a significant portion of their portfolio into a new, high-risk, speculative technology fund. The client has explicitly stated they are aware of the risks but are tired of conservative returns and believe this fund will offer substantial growth. However, Apex's internal risk assessment of this fund, based on its volatility and unproven track record, suggests it is not suitable for the client's stated long-term financial goals of capital preservation and steady income generation, which have been documented in their client profile. The client has also mentioned that a competitor firm has been promoting this fund aggressively. Which of the following represents the most appropriate course of action for Apex Wealth Management? Option A. Inform the client that while the fund is high risk, the firm can facilitate the investment if the client signs a waiver acknowledging they understand and accept all associated risks, thereby absolving Apex Wealth Management of liability. Option B. Recommend a smaller token investment in the speculative fund to satisfy the client's immediate desire for exposure, while continuing to manage the majority of their portfolio conservatively, and subtly highlight the risks of the speculative investment. Option C. Proceed with the investment as requested by the client, emphasizing the potential for high returns and the client's stated desire for growth, while including a disclaimer about the speculative nature of the fund. Option D. Advise the client that the fund is not suitable based on their documented financial goals and risk profile. Explain the specific reasons for this assessment, and offer alternative investment strategies that align with their objectives, while also documenting the conversation and the client's decision if they choose to proceed against advice. The correct answer is D. Advise the client that the fund is not suitable based on their documented financial goals and risk profile. Explain the specific reasons for this assessment, and offer alternative investment strategies that align with their objectives, while also documenting the conversation and the client's decision if they choose to proceed against advice. Explanation. This scenario presents a professional challenge due to the inherent conflict between a firm's desire to retain a valuable client and the regulatory obligation to act in the best interests of clients and the market. The firm, Apex Wealth Management, must navigate the complexities of client suitability and the potential for misrepresentation, requiring careful judgment to uphold its fiduciary duties. The correct approach involves Apex Wealth Management conducting a thorough, independent review of the client's financial situation and investment objectives, and then providing advice that is strictly aligned with those findings, even if it means recommending against the product the client is interested in. This upholds the regulatory framework by prioritizing client suitability and preventing misrepresentation. The Financial Conduct Authority (FCA) Handbook, specifically the Conduct of Business (COB) Sourcebook, mandates that firms must ensure that any investment recommendation is suitable for the client. This includes understanding the client's knowledge and experience, financial situation, and investment objectives. Recommending a product that does not meet these criteria or failing to adequately assess them would be a breach of these principles. Furthermore, the principle of acting with integrity and due skill, care, and diligence, as outlined in the FCA's Principles for Businesses, is paramount. An incorrect approach would be to proceed with the recommendation solely based on the client's expressed interest without independent verification. This fails to meet the suitability requirements and could lead to a misrepresentation of the product's appropriateness for the client. Another incorrect approach would be to subtly pressure the client into accepting the product by downplaying risks or exaggerating potential benefits, which constitutes mis-selling and violates the duty of fair treatment. Finally, a flawed approach would be to simply refuse the client's business without offering alternative, suitable solutions. as this may not fully discharge the firm's duty to provide appropriate advice where possible. Professionals should employ a decision-making framework that begins with a clear understanding of regulatory obligations. This involves identifying potential conflicts of interest and prioritizing client welfare. When faced with a client request that appears to conflict with suitability requirements, the professional should gather all necessary information, conduct an objective assessment, and then communicate their findings and recommendations clearly and honestly to the client, explaining the rationale behind their advice. If the client insists on a course of action that the firm deems unsuitable, the firm must document this thoroughly and consider whether it is appropriate to continue the client relationship.